We are breaking down the 7 lesser-known investing strategies Warren Buffett used to amass one of the greatest fortunes in history. From disciplined boundaries that protected early capital to bold moves made when others panicked, these principles reveal not just what Buffett bought, but how he thought, and why his results left Wall Street stunned. Some strategies may defy what most investors expect. Let us begin at the origin, with the foundational rule that shaped every move that followed. In 1957, Warren Buffett sat down in Omaha and typed a letter to his earliest partners. He promised he would only invest in businesses he could truly understand. That idea became his circle of competence, the cornerstone of his approach. He wrote, "I will not engage in trading on market fluctuations, nor will I buy a business outside my circle." Buffett's discipline did not just come from theory. During those early years, he passed on dozens of fast-growing industries and complicated companies, sticking to sectors where he could explain the cash flows, risks, and competitive landscape in plain language. Railroads, utilities, and insurance were fields he studied inside and out. By refusing to chase what he called outside knowledge bets, he filtered out opportunities that looked tempting but carried hidden dangers. The results spoke for themselves. Between 1957 and 1969, his partnership delivered an average annual return of 29.5%, while the Dow managed just 7.4%. That outperformance was not built on wild speculation or chasing trends. It was the product of knowing exactly where his expertise ended and never crossing that invisible line. But even Buffett was not immune to mistakes. In 1965, he bought control of Berkshire Hathaway, a struggling textile mill. The numbers looked attractive, but the business was outside his true circle of competence. Years later, he would call it a dead end and admit it was a costly error. By the time he closed the last mill in 1985, he had already pivoted Berkshire toward insurance, a field he understood deeply. The lesson was clear: defining your limits protects not just your capital, but your ability to act decisively when genuine opportunity appears. This self-imposed boundary became the filter for every decision that followed. It is the intellectual bedrock behind Buffett's fortune, a simple rule written in 1957 that still shapes his empire today. In October 1987, global stock markets crashed, wiping out hundreds of billions in value within days. Most investors scrambled for safety, but Warren Buffett waited and watched. Over the next 12 months, he quietly built a position in one of the world's most recognizable brands, Coca-Cola. By the end of 1988, Berkshire Hathaway had spent $1.3 billion to acquire nearly 7% of the company, paying just over 4 times book value for the shares. This was not a speculative bet on a rebound. Buffett's reasoning was simple, almost old-fashioned. Coca-Cola's brand, global reach, and steady cash flows made it a business with earnings power that could be estimated far into the future. He calculated the cash the company would likely generate over decades, discounted it to the present, and compared that figure, the intrinsic value, to the market price. The gap was wide enough to offer what he called a margin of safety. In his 1989 annual letter, Buffett wrote that they bought wonderful businesses at sensible prices, and that Coca-Cola's brand was worth far more than its book value. The numbers backed him up. While the market still shuddered from the crash, Coca-Cola's profits grew steadily. Berkshire's cost basis worked out to around $6.50 per share. Over the next decade, those shares traded above $80, and the dividends alone returned more than the original investment. Buffett's approach was rooted in discipline. He did not chase the lowest price or the hottest trend. He focused on companies whose cash flows he could predict and whose competitive advantages, such as Coca-Cola's global distribution and marketing muscle, were nearly impossible to erode. The purchase price always had to offer a cushion, protecting him from the unknown. The Coca-Cola investment became a textbook example of buying durable cash flows below intrinsic value and letting time do the heavy lifting. It also set the stage for Buffett's later, even larger bets, showing that the right price for the right business, inside his circle of competence, could justify extraordinary concentration. In the winter of 1963, American Express found itself at the center of a national scandal. A New Jersey company had faked millions of dollars in salad oil inventory, using forged warehouse receipts to borrow against barrels that, in reality, were filled with little more than seawater. When the fraud unraveled, it left banks and investors exposed. American Express, whose subsidiary had guaranteed the warehouse receipts, faced staggering losses. Headlines speculated on the company's collapse. Its stock price was cut in half in a matter of weeks. While Wall Street panicked, Warren Buffett traveled to New York and began his own investigation. He visited restaurants and spoke with business owners who relied on their American Express charge cards. What he found surprised him. Despite the headlines, the public's trust in the brand remained unshaken. For most customers, American Express was still synonymous with safety and credibility. Buffett concluded that the scandal, though costly, would not destroy the company's reputation or its core business. Armed with this conviction, he made a decision that startled even his closest partners. Over the next several months, Buffett's partnership quietly accumulated a position in American Express that eventually amounted to about 40% of the partnership's total assets, nearly $13 million at the time. It was a bold move, one that flew in the face of conventional wisdom about diversification. Instead of spreading risk across dozens of companies, Buffett concentrated his capital in a single battered franchise he believed was fundamentally sound. The risk was real. If American Express had failed, the partnership's capital would have been decimated. But Buffett's analysis gave him an edge. As the dust settled and the company worked through its liabilities, the market slowly recognized that the business was not only intact, but poised for recovery. Within a few years, the American Express investment returned nearly 10 times the original outlay. This episode revealed a defining trait of Buffett's strategy. It was the willingness to bet big when the odds were overwhelmingly in his favor. For him, conviction mattered more than comfort. Concentration, not diversification, became the engine of outperformance when the analysis was deep, the edge real, and the courage to act unwavering. The American Express bet did not just reward his partnership with extraordinary gains, it set a precedent for how Buffett would deploy capital for decades to come. In 1972, Warren Buffett paid $25 million for See's Candies. The price surprised Wall Street. The deal worked out to about 3.5 times book value, a premium that would have made his mentor Ben Graham wince. But Buffett saw something different. A business with a brand so beloved, customers lined up for its chocolates year after year, regardless of the economy. The cash See's generated did not just fill Berkshire's coffers, it became fuel for everything that followed. Buffett and Charlie Munger understood that owning the entire business, not just a slice of stock, unlocked the real power of compounding. With full control, they could direct every dollar of profit to wherever it would earn the highest return. See's required almost no new capital to grow, yet it sent more than $2 billion in pre-tax cash to Berkshire over the decades. Each year, those earnings could be funneled into new investments, acquisitions, or held for the next big opportunity. The original $25 million outlay became a perpetual cash engine, funding decades of growth. The See's deal pushed Buffett to think like an owner, not a trader. He was not just betting on a rising stock price, he was buying the right to harvest and allocate the company's cash for as long as the business stayed strong. This mindset later shaped even larger moves. In 2010, Berkshire spent $44 billion to acquire Burlington Northern Santa Fe, one of America's largest railroads. The scale was different, but the principle was the same. Buy the whole business, control the cash, and let compounding work at full strength. See's Candies proved that paying a premium for quality when paired with an owner's mindset could yield far greater rewards than bargain hunting. The steady stream of cash from See's and later from BNSF became the foundation for Berkshire's next wave of investments. For Buffett, control was not just about calling the shots, it was about capturing the full power of compounding year after year. September 2008 brought chaos to Wall Street. As panic spread and banks scrambled for lifelines, Warren Buffett picked up the phone. Within days, Berkshire Hathaway committed $5 billion to Goldman Sachs, not in common stock, but but as a perpetual preferred investment with terms rarely seen in modern finance. Goldman agreed to pay a 10% annual dividend, funneling $500 million a year directly to Berkshire, and offered warrants to buy 43 million shares at $115 each, exercisable at any time over 5 years. Buffett's approach was not about chasing bargains in the rubble. It was about structuring deals that protected the downside and captured the upside, even in a market on fire. The preferred shares sat above common equity, ensuring steady cash flow regardless of Goldman's profits. The warrants offered a free call option on recovery. For Goldman, the deal brought instant credibility. For Berkshire, it resulted in $1.14 billion in dividends by the time Goldman redeemed the preferreds in 2011. The warrants, settled in 2013, added another $1.28 billion, bringing Berkshire's total profit on the deal to more than $2.4 billion, all from a single crisis-era allocation. Buffett explained his thinking in the 2008 shareholder letter. He wrote, "We like having a lot of money available, but we particularly like having it available at attractive prices." That sentence reveals a simple principle and a disciplined mindset about keeping optionality while waiting for value. The Goldman deal showed how capital held in reserve and deployed with precision could multiply retained earnings far beyond the reach of ordinary investments. This was a lesson in disciplined capital management. This was not a one-off windfall. Since 2012, Berkshire has repurchased more than $70 billion of its own shares, using excess capital to boost long-term value for remaining shareholders. Each decision, whether a crisis investment or a steady buyback, reflects the same principle. A CEO's highest calling is to allocate capital where it will earn the greatest return, not just for a quarter or a year, but across decades. Buffett's mastery of capital allocation, his ability to move quickly, structure terms, and keep cash working, became the engine behind Berkshire's compounding power. The Goldman investment was a case study in how opportunity, discipline, and smart structuring can turn a moment of fear into a generation of wealth. In March 1967, Warren Buffett paid $8.6 million to acquire National Indemnity Company, a modest Omaha insurer specializing in unusual risks. The move barely caught Wall Street's attention, but it quietly transformed Berkshire Hathaway's future. The secret lay in the mechanics of insurance float, a concept Buffett would later call his company's financial engine. Insurance float is simple in theory, but powerful in practice. When customers pay premiums, the insurer collects cash up front, long before it must pay out claims. As long as the business underwrites policies prudently, that money sits on the balance sheet for years, available to invest. It is not free capital, but if underwriting breaks even or better, the true cost of this float can be zero or even negative. Buffett once described it as money that does not belong to us, but that we get to invest for our own benefit. At the time of the National Indemnity deal, Berkshire's insurance float was modest. In 1970, Berkshire reported $39 million in float, essentially money held from policyholders that could be invested elsewhere. By 1980, that figure had grown to $237 million. By 1990, it topped $1.6 billion. The growth did not stop. Berkshire's 2023 annual report disclosed float of $164 billion, a sum larger than the market value of most Fortune 500 companies. Through disciplined underwriting, the average cost of float remained at or below zero for decades, giving Berkshire a structural funding edge that few rivals could match. This steady, low-cost capital supercharged every other investment strategy. Whether buying entire businesses or deploying billions into public stocks, Buffett could move with a confidence that came from knowing he had a permanent pool of investable funds. The model proved so robust that Berkshire expanded its insurance operations, eventually acquiring full control of Geico in 1996. Geico's float became another pillar, further amplifying Berkshire's reach across markets and industries. The ability to harness float relies on patience and careful risk assessment. Buffett often credited his managers, especially Ajit Jain, for maintaining underwriting discipline, even as the pool of float ballooned. The result is a funding model that has powered Berkshire's compounding engine for more than half a century, an invisible advantage that quietly fueled the company's rise from a struggling textile mill to a global powerhouse. In 1999, as the world rushed headlong into the dot-com frenzy, Warren Buffett stood almost alone. The S&P 500 soared 21% that year. Berkshire Hathaway inched up just 0.5%, an underperformance that drew headlines and ridicule. Tech stocks doubled overnight, fortunes were minted, and experts called Buffett out of touch. He refused to buy what he could not understand, declining to invest in internet companies with little more than a website and a promise. While others chased momentum, he reminded shareholders that patience and temperament matter more than hype. Buffett's restraint during the bubble was not simply a matter of stubbornness. He had seen manias before. In his 1999 letter, he wrote, "The fact that people will be full of greed, fear, or folly is predictable. The sequence is not predictable. By sitting out the dot-com surge, Berkshire missed the party, but when the bubble burst, it also missed the crash. Many of the era's hottest stocks would lose nearly all their value within 2 years. Berkshire, meanwhile, preserved its capital and was ready to buy when sanity returned. But temperament is not just about waiting. It is also about admitting when you are wrong. In 1993, Buffett acquired Dexter Shoe Company, paying $433 million in Berkshire stock. The business collapsed within a few years, and the shares used for the purchase, worth billions today, were gone forever. In his 2001 annual letter, Buffett called it the worst deal I have made. He did not hide the mistake. Instead, he explained it in detail so others could learn from it. The lesson is simple: even the best investors make errors, but only the wise admit them and move forward. Buffett's behavioral edge, his ability to resist fads, endure criticism, and own his missteps, became the quiet force behind Berkshire's resilience. He once said that success in investing does not correlate with IQ. What you need is the temperament to control the urges that get other people into trouble. Discipline, humility, and patience are the traits that safeguard every other strategy. As the list of secret investing tools comes to a close, it is clear that the most powerful advantage is not a number on a balance sheet, but the mindset that endures when everything else is swept away. Across all 7 strategies, one truth stands out. Buffett's edge is not hidden in formulas, but in patience, discipline, and a relentless focus on quality. His fortune was built not by chasing trends, but by standing apart from the crowd again and again. In today's markets, that mindset remains the rarest asset of all. Thanks for watching. Share your thoughts or questions below.